Hi, I'm Scott Powell, and welcome to this week's Deeper Dive. This week, we're going to explore something that's been hitting the headlines recently. That's additional Tier 1 bonds, also called AT1 bonds for short. Now, if you don't know what they are, don't worry, I've got you covered. We're going to break down AT1 bonds into simple terms and then explore what's been happening in the headlines. So let's get started. Now, in order to understand what AT1 bonds are, we need to understand the nature of a bank's balance sheet. Its assets, its liabilities, and its equity. Now, the assets of a bank are typically primarily made up of loans to individuals and organizations. When we look at the liability side, or what it owes, a bank typically owes money to its depositors, its customers. You can think of us as depositors as lending money to a bank, which then the bank lends out. It can also owe money to bondholders. So a bank may actually issue senior secured bonds or senior unsecured bonds as a way of funding its loan book. So that's what it owes. And then we have equity. And this is where we can use the term capital and equity interchangeably. Now, when we talk about something called regulatory capital, it's actually a lot more nuanced and complex than equity, but it is very similar. So if you're new to regulatory capital, think about it as equity. Okay, so I've listed these according to risk. So if you think about customers or depositors at the top and regulatory capital at the bottom, depositors bear the least amount of risk. And what do I mean by risk? They're the least likely to experience losses. But because there's so little risk, they're entitled to little return. So think about the type of return you get on your savings accounts. At the other end, we have the providers of equity or regulatory capital. They take on the greatest risk. So they're the most likely to experience a loss and therefore are entitled to a relatively high return. Okay, so now let's explore regulatory capital, which I've called similar to equity in a lot more detail. Now, we're going to explore two specific types of regulatory capital, something called Common Equity Tier 1, or CET1 for short, and AT1, Additional Tier 1 Capital, or AT1 bonds in particular. Now, in a big picture way, just recall that the providers of regulatory capital are exposed to the greatest amount of risk. So the way this works is, for example, if a bank makes losses on its loan book, those losses are felt by the providers of regulatory capital, protecting depositors. So Common Equity Tier 1, as the name suggests, is the highest quality regulatory capital to absorb losses because it can absorb losses immediately due to the nature that it's equity. So when a bank experiences a loss on its loan book, that loss is felt directly by shareholders, or Common Equity Tier 1. But AT1, Additional Tier 1 bonds, also are a form of regulatory capital that can absorb losses. However, there's a small nuance. Recall, they're not equity, they're bonds. In order to absorb losses, these bonds need to be converted into equity. And that's what they are. They're actually called contingent convertible securities. You may hear jargon like COCO securities, and that again stands for contingent convertible. So given an event, the AT1 bonds actually convert into equity and then can absorb losses that the bank is experiencing. So as you can see, AT1 bonds bear a significant amount of risk and therefore typically have to deliver to investors a relatively high return. Now let's talk about three really unique features of AT1 bonds that sets them apart from other types of fixed income securities. The first is their loan loss absorption mechanism, which is typically triggered when a bank's regulatory capital falls below a threshold set by its bank regulator. When this trigger happens, the bonds either convert into equity, or in some instances, they're written down in full to zero. And whether they convert into equity or written down in full to zero really depends on the individual AT1 bond loan documentation. The second unique feature of AT1 bonds is that they have no maturity date. You heard me, there's no maturity date. Why is that? Well, regulators want regulatory capital to be permanent in nature. So we